Have you guys heard that bond yields are absolutely screaming now due to this trade war with the United States? Well, in this video, we are going to tell you guys exactly how it's going to affect your CMHC submission and why it might cost you a ton of money. Stay tuned.
Hey guys, Ehren and Josh here with another video, and today we thought it'd be very appropriate to talk about CMHC submissions and what it looks like for ceiling rates, what your actual contract rate's gonna look like, and what happens if you need to get into a buy down. Obviously this is a rising given in the last month from March to about mid-April. We've seen about 54 basis points increase in the actual bond yields. So I think it's a very appropriate topic right now to talk about. A lot of people don't fully understand the difference between submitting in a ceiling rate versus the rate that you're trying to get, and then what actually happens if those bonds rise above the rate that we submitted at.
Yeah, I mean, the beautiful thing about insured financing is the debt is all backed by something called the Canadian Mortgage Bond, or the CMB. Now, we have two types of CMBs. We have the 5-year and the 10-year CMB, and currently right now there is a massive gap between that 5-year and the 10-year. We're at like 60 basis points difference right now. We're almost at 3%. We're 2.96%, I guess, in the 5 as of today, and I think 3.6 almost on the 10-year. And choosing between the 5 and the 10-year, where to submit, how to submit, refinance or purchase, there's so many questions involved that go far beyond just like submitting an application. And as you said, we've seen massive variances in bond yields over the last few weeks, particularly due to global trade war and people fleeing to safe assets. This wasn't something that was expected. It's kind of a curveball that was thrown into the multifamily development space, and I think it's really appropriate and really important that people who are going to use this type of debt fundamentally understand the risks associated with taking it on and how to maybe mitigate any sort of risks if you were to find yourself in this situation. So let's get right into it. Start with the basics. What is a max rate or a submission rate? So when we submit a file to CMHC, we're submitting a file based off of a specific rate. That way your loan amount doesn't vary based off of where the bond yields are at, because the bond yields trade consistently every day, all day. So it wouldn't make sense for your loan amount to actually vary throughout the submission term. So what we need to do as brokers is we need to submit your file based off of a specific rate. Now, that rate that we choose is going to be based off a few different factors. It's going to be based off of whether you're purchasing a property or whether you're going to be refinancing a property. Now, if you're going to be purchasing a property, it would make sense to align your max rate or your submission rate with the maximum loan to value option that you have available. Most people who are using the product would like to use the product to minimize the equity position and maximize their overall return. So what you would do is you would submit at the maximum loan to value, and you would keep your max rate at the amount that would allow you to do that. Now, if you're going to be refinancing, you would also do the same, but you have a little bit more leniency in regards to where you submit at, because you have equity to buy down the rate in case you're in a situation where your actual rate is higher than what your max rate was.
Yeah, so when we're taking a look at submitting, so let's use a 5-year number. Let's just round it up to 3%. It's like two bips higher, just to make it easier, the numbers. That's gonna be your base bond, so at 3%. Then you're gonna have some sort of premium on top of that, and that's gonna be just where the lender is going to price your contract rate at, or where your spread's going to be. And let's just say it's 60 points above that. So you're going in at a 3.6. That's gonna give you your base underwriting and where the lender is likely gonna be in and around their contract rate. If we're doing it based off MLI Select, we're trying to get a 1.1 debt service. So let's just say we submitted it at 95% loan to purchase, shooting for a 1.1 debt service at that 3.6. If your debt servicing that we're getting at 95% and at 3.6 is right at 1.1, means you really don't have any room in your max or in your ceiling rate. That 3.6 is obviously the maximum rate that we can use to submit in to be able to get that 1.1 debt ratio. Now, in a different scenario, let's say we're using the same numbers, 95% loan to value and that 3.6. If your debt service was at 1.3%, obviously that means the property is performing very well and you're picking up a great asset, but it also means we have a lot more room in the bond spread to be able to keep your that target loan amount. So what we would do on the submission is we would increase the ceiling. Maybe we raise it to 4.25%. Basically, we're figuring out how high can we raise the rate before that debt servicing drops below or staying at that 1.1. So if we can increase that ceiling rate to 4.25 and your debt servicing is at that 1.1 debt service, that's going to be the ceiling rate that we're going to submit at, because that allows us to submit at the highest rate as possible and give us the most amount of buffer for any increases down the road when it comes down to where the bonds are at the time of funding.
Yeah, and the reason why this is important to you is recently, over the last, I'd say, few years, we've had massive variances in bonds. Bonds have been trading like equities have been trading, and historically that isn't the case. Usually it's a pretty stable asset, but that's not what we've seen. So you have inherent risk when you submit a file and the submission time takes upwards of 6 months sometimes to be able to submit. If you don't have equity in your refinance to be able to buy down that rate in a time when rates skyrocket throughout the term of the submission, you could be stuck in a really tough situation. Or if you're looking to maximize your purchase price and you have a really low max rate on the submission, you don't necessarily have the money or additional capital, what it takes to buy down the rate in which way you lock in at, you might be in a tough situation. So when you're looking at underwriting these deals, it's important to understand the stress test and stress testing the rate at maybe a higher rate than what you'd be submitting at or what you'd be comfortable and hoping to get, just to ensure that you have enough capital either on the equity side or additional down payment side when you're looking to take on a product like this.
Yeah, the next question is obviously what happens if you get the funding and the bonds have increased enough and then now you're above where that ceiling rate is. Well, there's two options. One, you can request a lender to go back to CMHC and see if they can increase that ceiling rate. It's not always guaranteed to happen. Obviously, it takes a little bit more time too. You do have to go back to CMHC and even see if they will increase the ceiling rate, so it's not guaranteed. Option number two is you basically go into a buy down situation. When we get into the buy down situation, really what you're looking at doing is you're putting some liquidity into the deal and you're essentially just prepaying part of that interest to relieve the debt servicing. This is usually where the scenario ends up happening as a solution. And then there's two ways that you can go about the buy down. If you're going into a purchase, obviously there's no equity in the deal other than the cash that you're putting in. So the buy down is going to happen directly out of your pocket. It's going to be cost out of pocket at the time of closing. If you're going to refinance, there's a little bit of a benefit there because now you can start to use the actual equity of the refinance towards that pay down and not capital of your pocket. So it's a little bit easier. Obviously it comes out of the net numbers, but it feels a little bit better than putting cash directly out of your pocket like you would have to on a purchase.
Yeah, and essentially what you're doing is you are buying the rate that you lock in at down to the rate in which you submitted the file at throughout the term of the loan. So on a 5-year term, it's obviously going to be half or almost half as what a 10-year term would be. So if you're taking 5-year debt and you have a buy down situation, it's not going to be as impactful as you take a 10-year. So when you're looking at choosing which term you're going to take on submission and you, let's say, commit to a 10-year bond and that buy down is significant, you could have an impactful amount of capital required to come up with, or it might be quite a significant impact to your refinance. We've seen buy downs in the 6 figures on equity takeouts due to rising bond yields.
Yeah, obviously, all the decisions around this, you're really just trying to base your decision on economic factor. I mean, there's a little bit more that goes into your decision between going a 5 or a 10-year. I wouldn't necessarily make that decision 100% based on, well, the 10 years going to cost me more in a buy down situation than a 5-year is, so I'm going to go 5-year. Obviously the 5-year bond, there is a renewal risk as well too, depending on where the environment is. So don't just make your decision based on simply what the cost of a buy down is going to be. You should really try to eliminate that as much as possible with good underwriting and being a bit more conservative on the rate.
I think that's a great point. Talking about renewal risk really quickly, a lot of people don't necessarily think far enough along ahead when they're taking on this type of debt to factor in that renewal risk. If you're in Ontario and you have a fully stabilized building, for example, and you're 95% loan to value, and then you add on your insurance premium and you're 97% loan to value, and you only have the ability to be able to increase your rents 2.5% annually year over year, and assuming you're at the absolute top market rent you possibly have, let's say for example the feds are correct and the data that's coming out, we have 2 flat years of rental growth in the rental market in some areas, you don't necessarily have enough lift in your rent to be able to get you to that 5-year. At the 5-year mark, maybe you don't have a significant increase in your net operating income, and there is inherent risk if we have much higher bond yields. When you're renewing into a higher bond yield situation, you could be underwater where the cost of the debt at the end of your 5 years on renewal is actually higher than the NOI can support. So, when you're looking to take on, either a 5 or 10 year term, it's not, as you said, about your buy down. It's also about insulating yourself from risk overall. If you don't have the ability to drastically increase the NOI, or you think you're going to have, some units that are really low rented turnover through that 5 years, it's important to understand the risk associated with when that term is going to end, and what is your net operating income going to look like in 5 years from now when maybe bond yields are inflated.
Yeah, for sure. There's definitely quite a few things that go into that decision, and it's more than we could probably get to in this specific video topic. And going back to just general economy, again, this is really where we're trying to base a decision when we do the initial underwriting. Realistically, when we're doing, when we're taking a look at the numbers, it's really just how high can we get that ceiling rate, and how much comfortability is there going to be in a normal market. When we're not dealing with 50 basis point swings, having 25, 30 basis points in buffer of your ceiling rate is probably enough for you to feel comfortable. In today's market, where you're dealing with, kind of Trump just pressing the on and off button with tariffs, and watching the bonds jump up, down, seeing like 20, 30 basis point swings every like 2 weeks, I'd probably use maybe more of like a 50 basis point, or just as high as you can even, stress test your rates at, right? And then just trying to figure out, what the best way to submit it is. Like, how far away are you? If you're taking a look at a construction project versus immediate purchase, your projections for your bonds are going to be different, right? If you're still 18 months away from SPA versus a purchase that's going to close in, potentially 90 days, you're going to have to try to look a little bit more forward in terms of economics and what that looks like. So maybe, on the construction project, maybe you're trying to stress test it closer to 1% or 75 basis points. Whereas a closing that's going to happen in 3 months, maybe you're fine using a quarter point to 50 basis points. So again, the type of project and the timeline is also going to determine where we're going to be underwriting that rate at, and how much of a risk you're at for the bonds moving.
Yeah, absolutely. There's so many different variables to consider when you're looking at taking on this type of debt. Looking into the future, I think it's hard for even like the professionals who do this for a living, economists, understanding exactly what's going to happen. But most of the clients who are like institutional level clients are guys who have larger buildings. Most of them take 10-year debt, even though it's more expensive currently. A lot of them are looking at mitigating risk overall and locking in long-term yields and long-term gains, so they can understand the projected growth of their asset over time. I think 5 years is almost, it's too small or too short of a time period for the cost of the debt, when you're looking to take on that type of risk.
Yeah, if you're dead set on selling a project in 5 years, or where a lot of mid-sized guys are, if you're borrowing, investor funds, or you have shareholders that you have to pay back, going with a 5 year is going to provide you an easier opportunity to do some sort of refinance or sale to really get your shareholders paid back. Like Josh said, if you're just buying it yourself and you just plan on holding this building forever, locking into a 10-year rate in the high 3s, low 4s, it's not a bad rate to lock into long term. So again, quite a few things that go into that decision as to whether or not you're going to be going with a 5 or 10 year.
Yeah, we understand that this isn't everybody's cup of tea, and we kind of nerd out about this. This is what we do for a living. We love what we do. But if this is something that you guys have any questions about, and you're looking to go through a CMHC mortgage, or you're currently going through one, or you have questions about one you're already in, we'd love to sit down and have a conversation with you just about the bond yields, what you can expect, how to maybe plan out and strategize your submission. I think the intention of the video really is just to let you guys know there's more thought process that goes into the decisions around these types of products than just choosing something. The type of debt you're taking on is very rigid, and it's a long-term debt facility made for institutional level financing. So again, we love what we do, and we're happy to sit down and kind of explain this to you in depth, individually for each unique situation. So if you guys did like this video, we'd really appreciate it if you hit the like button, hit the subscribe button. It allows Ehren and I to shoot more cool videos like this for you, so we can teach you guys how to keep building. Appreciate your time.